Have you ever come across an amazing property that was perfect in pretty much every way, but you didn't have the funds to acquire it? Unless you have $800,000 just lying around, this has probably happened to you, whether purchasing an investment property or your primary residence. So in this video, I'm going to share with you some of the different ways that you can get the money in order to finance your real estate deals. Hey, what's going on? My name is Steve LoPresti. I'm a real estate agent and property manager here in Hamilton, Ontario. And on this channel, we talk about everything that has to do with real estate investing in Hamilton and beyond. So if that's something that's interesting to you, please subscribe so you don't miss any videos. We're going to be putting out one every single week. There's a lot of different options and strategies you can choose from, and which one works best for you will depend on your individual circumstances. So what you're using the funds for. Flipping will be different than buy and hold, what type of property you're buying, what your financial situation is like, and so on. So keep your circumstances in mind and choose the best option that works for you, and remember to speak to a qualified professional to help you out. All right, so the first real estate financing method and the most common is A-lenders. So A-lenders is the term that is used to refer to the big five banks. You have CIBC, RBC, BMO, TD, and what's the last one? And Scotiabank. Traditionally, the way we finance real estate is to go to the bank and attempt to qualify for a mortgage. This is a solid route to go if you are able to, but it will have some limitations. These lenders typically offer better terms and lower interest rates than B lenders do, which I'll get into next. As investors, it's important to not just focus on interest rates. You want to make sure that if you are planning to acquire multiple properties, that you go with a lender who will allow you to get multiple mortgages. If you have good credit and a stable income, your chances of qualifying for a loan with an A lender are much higher. A lenders will also look at the condition of the property itself that you are purchasing. So if you want to buy something that is in pretty poor condition and you are planning on fixing it up to increase the value, which is what a lot of investors do, it's a pretty common strategy, then it might be a little bit difficult to get an A lender to finance that property. It's best to consult a mortgage broker and let them know your investing strategy so that they can determine what the best type of loan for you to get would be. One bad loan could offset your debt to service ratio to the point where getting another property is extremely difficult, if not impossible. So if A lenders are not an option, then there's always B lenders you can consider. If you have poor credit or a less than stable income, or just overall your financial situation maybe isn't the greatest, B lenders will be a better option. B lenders are alternative lenders and credit unions that offer loans to individuals with less than perfect credit and maybe an unstable income. So it could be a good option for you. B lenders will typically have a much more lenient lending criteria than A lenders will. However, they also charge a higher interest rate in order to offset the additional risk they're taking on by giving out loans to people with worse financial situations. All right, so the next option that you can consider when financing real estate is to go with a HELOC, and that is a home equity line of credit. This allows homeowners to borrow money against the equity that is built up in their homes. If you are a homeowner or you have other investment properties, you likely have some equity built up in those properties just from appreciation over time, but also from paying down the loan every month when you make your mortgage payment. A HELOC works kind of like a credit card where you can borrow up to a certain amount and then make monthly payments on the amounts that you've borrowed. If you don't have large enough savings, then this could be a great way to cover the down payment or even the entire cost of purchasing another property, depending on how much equity you have and how much of a line of credit you're able to pull out. HELOCs are a great option because you can often get the money at a very, very low interest rate. Now, the next option that you have for finding the money for your real estate deals is refinancing. Refinancing is the process of replacing your current mortgage with a new one that often has better terms such as a lower interest rate or a longer term. This is another great way to tap into the equity that you have built up in a property that you have, whether again, an investment property or your primary residence. Typically, you will receive the money as a lump sum payment directly into your bank account, which you can then go and use to purchase another property. This can be a great option if you're having trouble getting an A lender to lend on a particular property that maybe is in poor condition. Say you want to flip a house or do the BRRRR method. This is a way for you to basically use your home equity instead of getting a mortgage on that property itself. Once you've fixed up that property, and depending on what you do, if you want to sell it, you can do that, or if you want to rent it out and refinance, you can do that as well, and then get an A lender to lend on it because now it's in good condition. A lot of investors will prefer to refinance their investment properties instead of tapping into their home equity. Now, another option you have if any of those previous ones don't work for you is to go with a private lender. Private lenders are individuals or companies who offer loans to individuals or businesses in order to use it for whatever the particular circumstance calls for. These lenders often have a much more flexible lending criteria and are more likely to be willing to loan to individuals with poor credit histories, unstable incomes, or just limited income. As a result, private lenders will usually charge a much higher interest rate than you could get with other A lenders or B lenders. This could be a good option for borrowers who need to get a loan and need to get access to cash quickly and they can't get one from the other methods that I previously mentioned. You can also get involved in private lending yourself if you have the money and you want to invest in real estate, but you don't have the time or you don't really want to get involved in the process yourself. You can lend the money out to others, charge a good interest rate on it, and get a good return on your funds without having to do any of the work. Private lending is usually an unregulated industry, so it's best to consult a lawyer before signing any documents so that you know what you're getting yourself into. Now, if you're thinking, oh, I don't have any properties to refinance or get a HELOC on, or I don't have a very good financial situation to go with an A or B lender, or even private money is too much for me, then there's always the option to go with a joint venture. Joint ventures is the strategy that a lot of real estate investors have used in order to scale up their portfolios to massive levels relatively quickly. A joint venture is a business arrangement where two or more individuals pool their resources together in order to work on a certain project. In real estate, joint ventures are often used to combine capital, expertise, and resources in order to purchase or develop a property. You might have to eventually, depending on what your goals are with real estate investing, go with joint ventures eventually, because you're going to run out of your ability to finance for traditional mortgages, and you're going to run out of equity in your houses in order to pull out with a HELOC or refinancing. So you're going to probably have to use other people's money at a certain point. This can be a great way to invest in real estate depending on your certain situation. So if you are somebody who understands real estate, you understand the game, but you're out of money or you don't have the funds to purchase a good deal, you can approach somebody who has the money but doesn't have the time to invest in it or doesn't have the knowledge to invest in the deal. You bring it to them and then you can split the equity depending on your situation and how you want to structure things. So if you cannot go with any of the previous financing options I've mentioned, you can bring on a partner who can. This can be a great way to invest in real estate if you find yourself lacking the capital to do it yourself. So say you find a great deal that you have the knowledge and the expertise to capitalize on, but you can't qualify for the mortgage or you don't have enough money for the down payment. You could bring on a partner who provides the funds. Maybe they qualify for the mortgage, they get the funds for you, you do all the legwork, and then you guys split the equity 50-50 or however you want to structure it. This is one way that people use joint ventures, but there's a lot of different ways you can do it. Maybe you have a friend who also is going to do some of the work, and then you have some of the funds, they have some of the funds, and you pool them 50-50 and you split it right down the middle in terms of who's doing work and who's providing resources. On the flip side, it can be a good option as well. If you have the funds to invest in real estate, but you don't really have the time or you don't want to put the work in it or you don't really know what you're doing, you can invest that money with somebody who can. They'll do the project and then you still get a decent return on your money. Now, with finding JV partners, that could be a little bit tricky. The best way to go about it is to start expanding your network. Talk to more people, go to networking events. This will also help just build your knowledge base as well. If you're fairly new to this and you don't even know where to get started, that's a good option all around. Your joint venture partners could also be parents that you have. Maybe they have equity in their house and they're able to get a HELOC or refinance it or something in order to help invest into a property that you're buying. Or if you have any other friends that you know, just have a conversation with them to see if that's something they'd be interested in doing. I'll put out another video going more in depth into joint ventures, how to structure them. So if that's something you would like to see, just leave a comment, let me know. Real estate investors have tons of different ways that they can finance their deals, and you may have to get a little creative depending on your situation. You want to research and pick the best strategy that works for you. It's important that you don't over leverage yourself either, right? You don't really know what's right around the corner, and you always want to have a little bit of a buffer built into your deals so that in the event something does happen, you're protected. Make sure to talk to a mortgage broker to discuss your options when financing a deal. All right, thanks so much for watching. If you like this video, found some value in it, please like and subscribe. It would really help me out. And if you have any other topics you'd like me to make a video about or anything from this video you want me to go more in depth into, just leave a comment below just requesting that and I'll get on it as soon as I can. So you have the knowledge. Now what you have to do is take action and go and apply it. I wish you all the best. Now let's go make some money.